Inflation is a term used to describe the rate at which the general level of prices for goods and services is rising, and, as a result, the purchasing power of money is falling. It is often measured by the Consumer Price Index, CPI, and is a concern for policymakers, as it can have significant economic and social impacts. Causes of inflation. There are several causes of inflation, but they can broadly be categorized into two types: demand-pull inflation and cost-push inflation. Demand-pull inflation occurs when there is excess demand for goods and services relative to their supply. This is typically caused by an increase in consumer spending or investment, which leads to higher prices for goods and services. When the demand for goods and services exceeds the supply, producers increase prices to capitalize on the high demand. Cost-push inflation, on the other hand, occurs when the costs of production increase, leading to higher prices for goods and services. This can occur due to an increase in the cost of labor, raw materials, or energy. When the cost of production increases, producers pass on the additional cost to consumers in the form of higher prices. In addition to demand-pull and cost-push inflation, there are other factors that contribute to inflation. These include monetary policy. Inflation can be caused by monetary policy, which is the process by which a central bank manages the money supply and interest rates in an economy. When the central bank increases the money supply, it can lead to inflation by increasing the demand for goods and services. Exchange rate. Exchange rate fluctuations can also cause inflation. When the value of a currency decreases relative to other currencies, the prices of imported goods and services increase, which can lead to inflation. Expectations. Expectations of future inflation can also lead to inflation. When people expect prices to rise in the future, they may increase their spending now, leading to higher demand and prices. Effects of inflation. Inflation can have a variety of effects on the economy and on individual households. Some of the main effects of inflation include reduced purchasing power. Inflation reduces the purchasing power of money, which means that the same amount of money can purchase fewer goods and services than before. This can reduce people's ability to buy essential items such as food and housing. Reduced savings. Inflation can reduce the value of savings. If the interest rate on savings is lower than the inflation rate, the real value of savings decreases, reducing people's ability to save for the future. Uncertainty. High inflation can lead to uncertainty about the future direction of prices. This can make it harder for businesses to plan and invest, leading to reduced economic growth. Income distribution. Inflation can lead to a redistribution of income between different groups in society. If wages do not increase in line with inflation, the real value of wages decreases, leading to a reduction in the standard of living for some people. International competitiveness. High inflation can also reduce a country's international competitiveness. If the prices of goods and services in a country increase faster than in other countries, it can make exports less competitive, leading to a decrease in international trade. Solutions to inflation. There are several potential solutions to inflation, each with its advantages and disadvantages. Some of the common methods used to control inflation include monetary policy. Central banks can use monetary policy tools such as changing interest rates, reserve requirements, and open market operations to control the money supply in the economy. By reducing the money supply, the central bank can reduce demand and inflation. Conversely, if the central bank increases the money supply, it can boost demand and inflation. The effectiveness of monetary policy in controlling inflation depends on a variety of factors, including the state of the economy, the behavior of consumers and investors, and the response of other economic variables to monetary policy changes. Fiscal policy. Governments can use fiscal policy tools such as taxation and government spending to influence the level of economic activity and inflation. For example, if inflation is caused by excess demand, the government can increase taxes to reduce disposable income and reduce demand. Alternatively, the government can reduce spending on goods and services to reduce demand and inflation. Conversely, if inflation is caused by supply-side factors such as rising costs, the government can reduce taxes to stimulate supply and reduce the impact of rising costs on prices. The effectiveness of fiscal policy in controlling inflation depends on the size and timing of the policy measures, as well as the response of consumers and businesses to these measures. Wage and price controls. Governments can impose wage and price controls to limit the increases in wages and prices. This involves setting limits on the rate of increase in wages and prices and can be enforced through legal penalties or other means. Wage and price controls can be effective in the short term, but they often have unintended consequences such as shortages, black markets, and reduced incentives for businesses to invest and innovate. Supply-side policies. Governments can implement supply-side policies to address the underlying causes of inflation, such as high production costs. Supply-side policies include measures such as investment in education and training, infrastructure development, and reducing regulatory burdens on businesses. These policies can help to increase productivity and reduce costs, which can reduce inflation in the long run. Conclusion. Inflation is a complex economic phenomenon that can have significant social and economic impacts. It can be caused by a variety of factors, including excess demand and rising costs, and can lead to reduced purchasing power, uncertainty, and income redistribution. To address inflation, policymakers have a variety of tools at their disposal, including monetary and fiscal policy, wage and price controls, and supply-side policies. However, each of these solutions has its advantages and disadvantages, and policymakers must carefully consider the trade-offs and unintended consequences of each option. Here's a short story to explain the concept of inflation in simple terms. Once upon a time, there was a small village called Happyville. In Happyville, everyone had enough food, shelter, and clothing to live a comfortable life. There was a small shop in the village that sold fruits and vegetables, and the prices were always reasonable. One day, a group of travelers arrived in Happyville and they brought with them a lot of gold coins. The villagers were excited to trade with the travelers and soon the gold coins started to circulate in the village. Everyone had more money to spend and they started to buy more things, including the fruits and vegetables from the shop. The shopkeeper noticed that demand for his goods was increasing and he started to raise his prices. He figured that since everyone had more money, they would be willing to pay more for the same amount of fruits and vegetables. The villagers didn't notice at first, but soon they realized that they were spending more money to buy the same amount of goods. As more gold coins continued to flow into Happyville, the shopkeeper kept raising his prices. Soon, the villagers found that their money wasn't going as far as it used to. They started to complain and soon the village elders realized that they had a problem on their hands. They realized that the increase in the supply of gold coins had caused the prices of goods to rise, and this was what economists called inflation. The elders decided to take action to fix the problem. They talked to the shopkeeper and convinced him to lower his prices. They also decided to limit the amount of gold coins that could circulate in the village by creating a currency exchange system, where villagers could exchange their gold coins for a local currency that was tied to the amount of goods and services in the village. This helped to stabilize prices and ensure that everyone could afford the things they needed. From that day on, Happyville learned a valuable lesson about the importance of managing the supply of money and controlling inflation. They realized that too much money circulating in the economy could cause prices to rise and reduce the purchasing power of their currency. With the help of their village elders, they were able to find a solution to the problem and ensure that everyone in the village could continue to live happily ever after.